Afternoon, everybody, and welcome to the Society Right to be Forgotten for Cancer Survivors webinar. Good afternoon. We might just hang on for 1 minute. I see the number of participants still joining the call. So if you just bear with us for another 30 seconds or so, we'll get going. Okay, so I'm going to kick off. More people can join, and I can do the housekeeping in the interim. I just want to welcome everybody onto the call today. My name is Michael Sharp. I'm the head of actuarial practice with the Society of Actuaries in Ireland. Just going to do a bit of housekeeping. The webinar today is being recorded, and we hope to upload it to ActiveView in the next number of days. And we'll also have a YouTube link for our non-members who don't have access to ActiveView. So participants can ask questions at any time throughout the meeting by using the Q&A box at the bottom of your screen, and we'll go through the Q&A at the end of the presentations. Mention we will be seeking LIA and IOB accreditation for today's event, and if you want to get the codes, you can come back to the Society website where we'll make the codes available in the next 2 to 3 weeks when we get when we go through that process. Today's event, I just want to say that I'm delighted to be able to host today's webinar, which is a joint initiative between the Society and Insurance Ireland, and it's the first one we've had in a while. I'm very lucky today to be joined by 3 speakers on the topic, and I would suggest 3 speakers are the most knowledgeable on this topic and responsible for its success in this country. I think it's a great example of insurance professionals coming together to deliver something in the public good. And it's great to see it on the government. The government acknowledged this and included it prominently on its action plan for insurance reform 2025 to 2029. It's also been a very good collaborative initiative between Insurance Ireland and the Society, and both of our members have worked hard to ensure its success. I'm going to introduce the 3 speakers in turn now. First of all, we have Jacqueline Thornton from Insurance Ireland. Jacqueline is the Director of Regulation and Policy Development, Strategy and Member Relations at Insurance Ireland. She leads the development of the regulatory policy positioning with its members, and she and her team support the technical aspects of Insurance Ireland's lobbying and advocacy. In addition, she led the development and delivery of Insurance Ireland's 2025 and beyond strategy. Prior to joining Insurance Ireland, she worked in the UK for 15 years in a variety of regulatory policy and compliance roles within trade bodies, in-house compliance and consultants across a range of industries and in the financial services space. Jacqueline enjoys nothing more than meeting members for a coffee to discuss the regulatory hot topics domestically and from Europe, and working with members to shape regulation so that the insurance industry can reach commercial, viable and compliant solutions. I have to say, when I read that, I was a little bit disappointed I haven't been invited for a coffee with Jacqueline. But anyway, we can get back to that at a later point. Next up, Gavin Maguire. Gavin joined Hanover Re earlier this year as the Global Head of Life and Health Traditional Business, where he supports the market teams around the world and their clients to grow their business. Prior to joining Hanover Re, he spent 10 years at SCOR, including as head of UK and Ireland Life and Health Business. A past member of the SAI Life Committee and chair of the Life Reinsurance and Innovation Committee, together with Julie, he co-chairs the Society's Right to be Forgotten working group. Julie McCarthy. Julie is the head of actuarial function for Royal London, Ireland. She joined the company in 2018 as actuarial lead within the proposition team, where she was responsible for pricing and reinsurance strategy across individual protection products. Julie took on the head of actuarial function role in 2022 and continues to contribute to developments in pricing, reinsurance and underwriting. Julie was a previous member of the Life Reinsurance and Innovation Committee and is a current member of the Society's Demography Committee. Okay, so onto the competency wheel. The competency wheel is a tool that our members will be familiar with, maybe not so much non-society members, but it's a very useful tool, and I guess the idea of it is it will point out the specific areas in knowledge, skills, and attributes that we'll be covering today. So we'll be covering the areas of regulatory matters, industry issues, and risk management on today's webinar. And if we go on to the next slide, so the format of the discussion today, of our presentation, will be: up first, we'll have Jacqueline giving us an overview of the Insurance Ireland Code of Practice. Following that, Gavin will come on and we'll talk about the Society's paper on the right to be forgotten, a comparison of the Code of Practice to those in operation in other countries around Europe and elsewhere. Then up, we'll have Julie, and she'll be talking about the expected impacts of the Code of Practice. And again, taking from that Society paper that was issued a number of months ago and available on our website. And then lastly, we'll have Jacqueline come back on to talk about observed impacts of the code in 2024. Finally, we'll talk about where next from here, and then we'll go over to Q&A for some questions and answers. So please keep the questions coming at the bottom of the screen. So with that, I'm going to hand over to Jacqueline.
Thanks very much, Michael. Thanks everyone for attending. It's lovely to see so many people still having an interest in this topic. And don't worry, Michael, I'll organise that coffee. I might even stretch to a croissant if we're on a good day. So I was talking to Gavin and Julie actually earlier on when we were preparing for this. I'm kind of saying I'm kind of gone back in time. So I think a couple of years ago when this SAI had done their initial report and Insurance Ireland were launching the code, we were kind of out and about doing these webinars to try and raise some awareness. So it's really nice to come back with Gavin and Julie now and talk about what we've seen as the impact of the code for the first year. So as Michael said there, I'm going to give you a brief reminder of the Insurance Ireland Code of Practice for underwriting mortgage protection insurance for cancer survivors. Now, as we'll all remember, back in the time, a lot of this right to be forgotten concept originated from the EU Beating Cancer Plan. As part of that plan, it was looked at how cancer survivors were able to access financial products and services. And as part of that, the EU looked at the French approach to this, where a diagnosis of cancer would not need to be disclosed after a period of time when applying for an insurance product. So the cancer would effectively be forgotten for this purpose. And that would help support cancer survivors in accessing the insurance products they needed as they take their life on beyond their cancer diagnosis. This approach was then suggested as suitable for the Irish market from the Irish Cancer Society report. You might just go back one slide there, Paul. It's too quick, thank you. For the Irish Cancer Society report in 2021, and they noted the increase in people in Ireland who are living with and beyond cancer. And again, this report found that cancer survivors encountered a number of barriers when trying to access insurance at a rate higher than the general population. And that work then led to a private members bill in the Seanad in October 2022, which suggested a very broad right to be forgotten. In that it would apply to all insurance products. It started at a basis of 5 years since the end of active treatment. So from when the cancer survivor actually finished their treatment and were, considered a cancer survivor at that point. The risk involved in that from an insurance perspective was really quite high. And insurers and reinsurers felt this would have an impact on their risk appetite, which would inevitably lead to issues in accessing and affording insurance overall for everyone. So Insurance Ireland then sat down and kind of looked at this and thought, well, right, what can the insurance industry do? And the biggest issue really that was coming to the fore at that point, and still is actually, is around how most cancer survivors can't access mortgage protection cover. And of course, that's required for a lender to be able to give a mortgage for the individual to own their own home. So there was quite a blockage, or there appeared to be quite a blockage in terms of cancer survivors being able to access that lending. Now, when I talk about that, I do always like to remind everyone, there is, of course, the option for that requirement to be waived if the lender chooses to do so. But that was a very rare I suppose, course of action for most of the lenders. And in 2021, when this conversation was going on, the BPFI found that only 2% of mortgage approvals per year were actually granted a waiver, which is quite low. It was also noted that 0.05% of mortgage approvals did not proceed due to a lack of insurance cover. So from a numbers perspective, the numbers were quite low, but obviously for those customers, for those individuals, the impact was quite material. So our starting point was to look at the initiatives in other countries to understand how they would work and whether they would fit with an Irish context. There was a certain number of common elements really to each of these frameworks, and they included things like, the right to be forgotten applied after a certain period of time since the end of the active treatment for the cancer. Some frameworks are limited to specific products within insurance. Some applied a framework to all insurance products. Some countries would have introduced these changes through a voluntary code. Some was through legislation, and some of the frameworks were restricted to cancer or included in other conditions. Now, what felt like a really long time, but in effect was produced very, very quickly. I think it felt like a long time for those of us that were involved in it. Insurance Ireland developed a voluntary code that insurers providing life protection products in connection with the mortgage in Ireland could sign up to. So there's no membership requirement. However, at this point, Insurance Ireland does represent all the domestic insurers who are involved in providing that product in Ireland, and they're all signed up to the code, which is fantastic. Now, the main provisions was this would apply to life cover only in connection with the mortgage, and it would be on a principal private residence only. The issue, as I said, was really about people not being able to own their own home. So this was the specific issue this code was designed to target. There was a maximum mortgage amount of €500,000 per applicant. The common amount across Europe was about 200,000 per applicant, but given the cost of housing in Ireland, it was felt that that would not deliver the outcomes that the insurance industry wanted, and therefore it was raised to 500,000. Treatment for the cancer would have to have ended more than 7 years prior to the application, or 5 years where the individual was under 18. Now, the definition of the end of active treatment was actually devised in partnership with an independent oncologist and an actuary, and it was clearly defined in the code and applied across the sector. Probably most vitally, the cancer diagnosis would still be disclosed as part of any application, but would be ignored by the insurer. Now, this was important for a couple of reasons, and it was really to limit any issues at claim stage if the individual had misunderstood some of the parameters. It kind of reduced that risk because it would then down to the insurer to apply the code correctly. And it would also give the insurers a bit more certainty, allowing them to understand and quantify the risk they carried and maybe have less of an impact on capacity to offer insurance products. It would only apply to a cancer diagnosis. And it was important to note that comorbidities are not in scope, or were never in scope of the code. So, for example, if a lung cancer patient developed emphysema, the emphysema would be included for underwriting, but the cancer diagnosis itself would not. Now, there were some concerns, I think, when this was originally put on the table about how well the code would be applied if Insurance Ireland was both the drafter and the overseer. There was kind of we're concerned you're going to be checking your own homework. So from a reputational perspective, Insurance Ireland felt it would be better to include an independent check on the code to make sure that it is being delivered correctly. And to avoid it being a very long period of time, the agreement was the initial independent check would be done on implementation after 1 year. So to show that all the insurers signed up are actually delivering it properly. And then there would be an independent oversight on how effective the code was actually being for cancer survivors. And that would take place every 3 years thereafter. So if we move on, then it's great to see that all of the 8 main providers at that are signed up to the code and they remain signatories. And as I mentioned, all 8 are Insurance Ireland members currently. And the code was received very, very warmly, actually, when it was launched. So if we go on to the next slide, we can see that all the main stakeholders were very pleased to see action being taken. And one of the main reasons it was so warmly welcomed was because cancer survivors would see a real immediate change in the process. Now, it was understood this code would not cover all insurance cases, but it was a real game changer for the industry in how they stepped up to support this cohort. And that goodwill and that kind of reputational impact stands today. When the code was being discussed recently, Minister for State Robert Troy, again, gave kudos to the insurance industry for stepping up and devising a code to support cancer survivors. Now, as Michael said, I am going to talk to you about the one-year implementation report. Before that, though, I'm going to pass over to Gavin, who's going to talk a little bit more about the Society of Actuaries report.
Brilliant. Thank you, Jackie. So yeah, it was really great to be here with you as well. And it's nice to have the band back together as such or so. Maybe before we start into the review of the reports that the working group published, maybe give a bit of background on the working group itself. So in 2022, when some of the initial conversations that Jacqueline has mentioned in her presentation kicked off, we formed a working group to look at this topic, and we published our first report in April 2023. The aim of the working group was to put useful and factual data into the public domain to inform the discussion in an unbiased way, like not to take an opinion whether right to be forgotten framework is something that should or shouldn't be introduced. We didn't see that as our role of the Society of Actuaries. And so we've taken a similar approach in our latest report, which was published in July this year. So before I start, just a big thank you to all members of the group, in particular the non-members of the Society of Actuaries who joined. So people from the medical underwriting and claims community who joined us as subject matter experts to support our work. So if I start by looking back at our report from April 2023, which was very much about publishing some potential impact assessments, some potential things for actuaries to think about, and some data that we were able to collect. But the key findings from that report were the three that are on this slide. So firstly, that we would expect when a right to be forgotten framework for cancer survivors come in, that life insurance products will likely become more affordable for some cancer survivors. And hopefully if that is the desired impact, then this could be expected to lead to an increase in the number of cancer survivors buying life insurance products. Also, we would say that other consumers who have never been diagnosed with cancer are likely to see an increase in premiums if a right to be forgotten framework is introduced, as they'll be cross-subsidizing the consumers who meet the RTBF framework and criteria. So some consumers may consider this to be unfair, and depending on the scale of the increase in premiums, this could potentially lead to a reduction in the overall number of consumers purchasing life insurance products. And then finally, consumers that have recovered from other illnesses or diseases may feel unfairly treated, as they would still be required to disclose their prior condition, and that would be treated as normal. So as part of our work for this report, we worked with an underwriting technology provider who was able to share with us data from an 8-year period up to the end of 2022. This underwriting technology provider partners with 3 of the 6 insurers in the Irish market. So using this data, we were able to estimate that about 17,000 cancer survivors had applied for life insurance over the almost 8-year period. And that was 1.7% of applications overall. So 1.7% of applications had someone who said yes to the cancer question that was asked of them on the application form. For a cohort of the disclosures where someone said yes to cancer, we also had data on how long it was since they recovered from that cancer or treatment ended. So we estimate about 10,000 out of those 17,000 who applied for life insurance cover with the cancer disclosure had recovered or treatment ended more than 5 years ago. So approximately 1% of the applications overall. However, the data did compile so that automated underwriting decisions for these applications show that consumers who did disclose a cancer diagnosis did not get a point of sale decision, so an automatic decision at point of sale, but instead were referred to an underwriter for individual consideration. So to get a sense of what the decision, so the final underwriting offer would be, you want to just go back one there for a second, Paul, to understand what the final decision would be, we as a working group sent some notional application cases to each of the 6 life insurance companies operating the Irish market and asked them to underwrite those cases as if they're a real case, and give us the outcome they would likely offer both 5 years post completion of treatment and 10 years post completion of treatment. And this was for a range of different types of cancers. And this showed a couple of things. One is that it did appear that the type of cancer was a consideration in the in the underwriting decision that the insurer gave. So they didn't have a one-size-fits-all for all types of cancers. The severity of the cancer that had been suffered for which treatment had ended was a factor in the underwriting decision. So a number of insurers would accept applications for life insurance from cancer survivors with no extra premiums payable, both 5 and 10 years post completion of treatment, particularly where the cancer was early stage or it was a small tumor with no spread. However, the majority of insurers did indicate that applications are likely to be declined for the most significantly advanced cases, regardless of when treatment ended. It also showed that the duration since cancer treatment ended is a factor in insurers' underwriting decision, as we saw much broader availability of underwriting decisions and cover 5 years post completion of treatment compared to 10 years post completion of treatment. But it was noticed that in all scenarios assessed, life insurance was being offered from one or more insurers 10 years post completion of treatment, though it was increasingly likely the shorter the term, the more likely that would involve an extra premium payable. So lots of interesting things there that maybe wasn't the perception of how the market was working beforehand. Throughout the report, it showed that there was quite a lot of potential considerations for actuaries, medical underwriters, and claims assessors, from pricing, product development, risk management, on application forms, IT, to be considered as part of a right to be forgotten framework. So that was our original report, and it's available on the Society of Actuaries website if you'd like to look at more detail. So this year we worked on an update to that report. So 1 year post the implementation of the Code of Practice by Insurance Ireland, we wanted to do some work to firstly benchmark the Insurance Ireland Code against what we see elsewhere in Europe, and then secondly start to estimate what we think the parameters for the code are, the impact we think the parameters in the code are having. So Paul, if you want to go on to the next slide there. So yeah, we wanted just to make sure better understand the impact on what we would expect, how many people we would expect to benefit from the code, and understand the impact of the parameter. So what I'm going to do firstly is just do the comparison of the Code of Practice against the frameworks introduced in other European countries. I'll give a little bit more detail on some of the things that Jacqueline talked about. And then I'll hand over to Julie, who will look at the parameters and the expected impacts of the Code of Practice. So if we go on to the next slide then. So Jacqueline covered this a little bit in her opening there as well, but what I'll do is there's 9 or 10 categories, and in our report from July, there's an appendix which gives a lot of detail by country and how the Irish code compares against all these features. But here's just a summary. So if we start with the products covered, so from what we see across Europe, like in Ireland, most of the right to be forgotten frameworks introduced focused on mortgage protection insurance and credit life, as called in other countries. Though some countries did include things like business loans, which was the case in France, and other countries have included income insurance products like Belgium. And earlier this year, Belgium also includes travel insurance products. As we look from country to country and compare some of those products, the names of products might be the same, but how they get offered and how they get priced seem to be very different from country to country. So with more prevalence of fully guaranteed premiums in Ireland compared to some of the other countries. So while the focus is on mortgage protection insurance, some of the differences from country to country also need to be taken into account in terms of the products that are offered. The period since treatment ended. So for adult cancers, Ireland is somewhat more progressive than some countries at 7 years. In other countries in Europe, 10 years remains common. So Luxembourg, Netherlands, Portugal, Italy, Cyprus, and Greece all have a framework around the 10-year mark. Though it's worth noting that France and Belgium initially introduced a 10-year period, but have since reduced to 5 years. And Slovenia and Romania, consistent with Ireland, at about 7 years. There's pretty much uniformity across Europe for childhood cancers. So these are cancers that are disclosed or that are diagnosed in childhood. So a 5-year period in Ireland is consistent with the rest of Europe. Though some countries now apply this up to the age of 21 rather than 18, as the case in Ireland. Jacqueline mentioned this as well, but most countries have focused on a large topic of the conversation around this has been focused on cancer only. And this is the case in Ireland, Netherlands, Italy, Cyprus, Romania, Greece, and Czechia. Though some countries have now included hepatitis C and HIV as covered conditions. So Paul, we're going to the next slide there. So we had a look at how the sum assured restrictions in Ireland compared to other countries. So a number of countries, so Ireland, France, Luxembourg, Netherlands, Cyprus, and Greece do apply a max sum assured in their framework, and this varied from 280,000 euros in Netherlands to 1 million euros in Luxembourg. So some lower and some higher than the Ireland code with 500,000. However, some countries do not appear to apply a sum assured limit. Ireland doesn't apply an age restriction, whereas in Netherlands, a max age of 71 does apply. Ireland does apply a principal private residence requirement, and Luxembourg also does that, but it doesn't appear that some other countries have applied that requirement. When it comes to legislation or industry code of practice, so there's a mixed view. So Ireland is an industry code of practice currently, and that's the same in Luxembourg, Greece, and Czechia. But other countries have taken a legislative approach. Interestingly, in some other countries, they have implemented a supplementary reference grid. So as I said earlier in our report, there were cancers in our original work that showed were offered cover of 5 years post completion of treatment, and that would still happen today. So even with the code of practice, if an insurer can offer terms sooner, then they will. So they will be accepting some cancer survivors sooner than the 7-year period, depending, as I said, on the type and severity of the original cancer. But a number of countries across Europe have introduced a supplementary grid of periods for specific cancers, so have mandated the period for for specific types and severities of cancer. So some slightly different approaches there. So the next point is really one that Jacqueline mentioned as well, is around, if you want to go on to the next slide, Paul, so is around this concept of whether it's a requirement to disregard or a right to be forgotten. So the code of practice is consistent with the approach introduced in Italy, Greece, Cyprus, and Czechia, where the cancer survivor is still expected to make a full declaration of their past cancer, and the onus is on the insurer to determine whether that information should be used or disregarded. So in other markets like France, Netherlands, and Luxembourg, Portugal, Slovenia, and Romania, the applicant does not need to disclose their previous cancer diagnosis or treatment to the insurer once the requirement for the period since treatment has ended has been met. As such, I would describe the code of practice in Ireland to be considered as a sort of requirement to disregard framework rather than a full right to be forgotten approach. So, and there are benefits and advantages to that. So in particular, like it gives cancer survivors greater claim certainty, as responsibility sits with the insurer to use the information where appropriate and disregard where appropriate, and prove that they disregarded it. So it removes the possibility of a cancer survivor saying, okay, my cancer has ended 7 years ago post-application, but in reality it was 6.5 years ago. And so that could cause an issue at claim stage. So removes that uncertainty for the cancer survivor and means that the insurer, the onus is on the insurer to use the information where they can use the information and disregard the information where they have committed to disregard the information. And it also gives the insurer greater certainty of the risks they're taking on, because they understand how that 1.7% of applications with a previous cancer is changing over time. And potentially that benefits consumers by limiting the impact of any pricing changes. However, in the spirit of what a right to be forgotten framework is trying to achieve, it might be considered unfair on cancer survivors to require them to continue to disclose their previous cancer history. So that's the kind of main comparison of the code against what's happening in other European countries. As I said, there's a much more detailed table in the report that was issued, and a link to a website that is maintaining an ongoing comparison as this continues to develop across Europe. But now I'll hand over to Julie to take you through some of the data.
Thanks, Gavin. So I'm going to take you through, as Gavin said, some of the data that was collected to estimate the potential impacts of the code of practice, as well as to understand the number of cancer survivors that might be impacted by changing the parameters of the code. So working with an underwriting technology provider and 3 Irish insurers who use the technology from that provider, we were able to analyse anonymised disclosure data from the end of August 2014 to the end of December 2022, so just over an 8-year period. The data set shown here and in section 2 of our report included over 665,000 individual applications, of which over 11,000 included a disclosure of some type of cancer. So just less than 2% of the applications had a disclosure of cancer. The insurers participating in the analysis had an estimated life insurance market share of 50% in 2022. So we do believe it is a representative data set for the life insurance market in Ireland. So then looking at the parameters of the code and the decreasing mortgage protection only requirement first, our data showed that there were 4,305 applications from cancer survivors for decreasing mortgage protection within our 8.3-year period, representing 46% of the life insurance applications from cancer survivors during the period. And consistent with the overall data set, 1.7% of these mortgage protection applications had a disclosure of cancer. In terms of a potential limitation with analysing the historic data set to estimate future impacts, we noted it is possible that some cancer survivors who previously applied for other types of life insurance may now apply for decreasing mortgage protection policies to benefit from the code of practice. Our analysis showed that 3,856 decreasing mortgage protection applications from cancer survivors met the maximum sum assured requirement of €500,000. So 90% of the decreasing mortgage protection applications. However, again, we note this proportion was based on the historic data set up to the end of 2022. So inflationary impacts, and in particular house price inflation, are likely to have had an effect on and will continue to affect the actual number of cancer survivors impacted by this requirement. Based on the data shown in the previous slide, and assuming our data set represents 50% of the overall market, we estimate that approximately 7,700 cancer survivors applying for life insurance over our 8.3-year period would have met the product and sum assured criteria outlined in the code. And this translates to around 925 applications from cancer survivors per year who would meet those criteria. Next, we considered the impact of the requirement that treated must have ended at least 7 years ago. We had complete recovery time period data for just over 2,700 applications, representing less than 25% of all cancer-related disclosures. So while this is a relatively small data set, we compared the results with similar UK data and found the distribution to be broadly consistent. Among applications for decreasing mortgage protection with sums assured below €500,000, 47% had treatment that ended more than 7 years ago. So applying this proportion to the 925 cancer survivors per year who met the product and sum assured criteria, we estimate that approximately 435 individuals per year would have been eligible for consideration under the code of practice had it been in place during the period analysed. So looking then at the other aim of our updated report, which was to better understand the number of cancer survivors that might be impacted by changing the parameters of the code of practice. We estimated that if the eligibility threshold were reduced from 7 years to 6 years since treatment ended, then an additional 74 cancer survivors per year would qualify to have their cancer history disregarded. A further reduction to 5 years would bring in another 65 individuals annually, resulting in a total of 574 eligible cancer survivors per year. However, it's important to note that including these additional lives may have a greater impact on premiums for other consumers, as the risk of cancer recurrence generally increases the shorter the time period since treatment ended. And in terms of the future outlook, it's reasonable to expect, with the code of practice now in place and assuming that it successfully shifts perceptions among cancer survivors and their advisors, that more cancer survivors will apply for decreasing mortgage protection cover than in the past. So therefore, eligibility numbers are likely to exceed historical estimates, assuming all other factors remain constant. Just to note that we were unable to estimate the impact of the principal primary residence requirement, as the data set didn't include this information. I'm now going to hand back to Jacqueline to take us through the actual experience so far since implementation of the code.
Thanks very much, Julie. Okay, so as I mentioned earlier on, part of the code was a commitment to appoint an independent consultant after the first year of implementation of the code to assess and check that all of the insurers who had signed up were implementing the code as it should be. So after a tender process in December 2024, Forvis Mazars were appointed as the independent consultant. So if you want to move on there, Paul. Work began with the firms in January 2025, and the final report was made public in May 2025. Fabulously, the review found that all 8 of the insurers were fully adhering to all provisions of the code. So that meant that all cancer diagnoses where treatment ended 7 or more years ago, or 5 where the diagnosis was in under 18, were excluded from the underwriting process, and cover of up to a mortgage amount of 500k per applicant was offered. Moving on now to the key facts. There were overall, during that 13-month period, there were 1,300 applications for decreasing term assurance in connection with the mortgage where a malignant cancer diagnosis was disclosed. 50% of those applications, so 650 individuals, received cover under the code because they met all the parameters. So were offered standard rates with a streamlined, less intrusive, quicker application process. For the 50% that did not meet the provisions of the code, the majority of these cases related to not meeting the 7 years since the end of active treatment. The second most common reason they didn't meet the parameters of the code was that the mortgage was not for a principal private residence. So the application was outside the scope of the code, regardless of the cancer diagnosis. There was also a minority of applicants who were not offered cover at all, but that was due to other health conditions outside of the cancer diagnosis. But it really needs to be noted that of those 50% of applications which did not meet the parameters of the code, a further 400 of those were actually still offered cover, even after going through the manual full underwriting process that Gavin was talking about earlier, having to provide additional evidence, taking a bit more time to go through the application, but 55% were offered cover at standard rates. So a total sum assured of 96 million worth of cover was written under the parameters of the code. It doesn't include the further amount that was offered for the cancer survivors outside of the code, as this report was simply focusing on the details of the code itself. The average age of an applicant was 43 years and the average mortgage term was 22 years. So going on to some further key facts around the period since the end of active treatment. 45% of all of those applications received ended active treatment more than 7 years ago. 23% of those applications ended the active treatment more than 6 but less than 7 years ago. 18% ended active treatment more than 5 but less than 6 years ago. And 14% of those applications ended active treatment less than 5 years ago. So of all of the applicants that did receive cover or that were offered cover for that period of time, so there was 1,050 applicants, 80% of those applications received cover at standard rates, and a further 20% did receive cover, albeit at increased rates. So really, this does demonstrate that even without the introduction of the code, cover is available for the majority of cancer survivors, albeit at an increased premium or with a slightly longer application process. And I think that's the thing we're hoping that the code will help to promote, that awareness that cover is available. Go through the process. If you meet the code, it will help actually streamline your process and, you know, make you more comfortable that you're going to get the cover. But still, even if your case does not meet the actual parameters of the code, that doesn't mean cover is not available. Different insurers have different risk appetites. And that was one of the reasons Brokers Ireland actually set up what they call a specialised broker register. And these are brokers who are used to dealing with what we call non-standard cases. So it is quite important that cancer survivors do have the confidence to apply for mortgage protection cover and other insurance products. So moving on now to the findings and the observations. Obviously, as I said, happily, the code was found to have been applied to all applicants who met the criteria and the parameters of the code. It was interesting to note as well that some applicants who were under the timescale of 7 years were brought into scope. So for example, if there was an applicant and they were 6 years, 9 months, let's say, since the end of active treatment, they were still brought into scope because by the time they drew down on their mortgage and started their policy, it was likely going to be over the 7 years anyway. So it was great to see insurers applying some of that flexibility to individual cases. The code applied only to decreasing term assurance for principal private residents, as we talked about. And it was also interesting to see that none of the 8 firms who have signed up to the code sought evidence of the end of the active treatment. So the customer's declaration was accepted. Now, there were some differences in how the cases of over 500k were written. So for some firms, they accepted the first 500k as part of the code and manually underwrote, as per normal underwriting, the remainder of the amount above 500k. Other firms took a view, well, actually, this doesn't meet the parameters of the code, so we will underwrite it as we normally do. Increased rates did apply to some of the cases. However, that was only for non-cancer disclosures. Where cancer was disclosed and met the parameters, there were no increased rates applied to that disclosure. Now, there were limited risk compliance and audit reviews, but you'd expect that. We were only 12 months in, and really the process didn't have time to be scheduled into the more longer term second and third line in external audit reviews. And it was found that there were no complaints made to the Financial Services and Pensions Ombudsman. There was one insurer, I think, who reported one complaint, but when that was actually escalated, it was found it was the customer was not in scope, and once that was explained, the complaint was fully resolved. So moving on to the recommendations, the report really provided solid independent evidence that the mortgage protection products are available to many cancer survivors without the increased cost. It was quite interesting, as Gavin had said, when we started this debate a few years ago, there really was no data that came in that to show us what the impact of a right to be forgotten framework was on the insurance products and availability of insurance, and what the impact would be from an actuarial perspective. The Society of Actuaries report was one of the first ones that attempted to do that, and certainly when our code was being reviewed, there were a lot of eyes on the results, not just domestically, but those European jurisdictions were also looking at what evidence was going to come in from Ireland as well. So it was really great to be able to show this independent evidence that cancer survivors were being supported and were able to access the products that they needed, albeit inside or outside the code. Now, for some applicants, the cost of the policy actually didn't change whether the code had been in or not, because they would have been offered standard premiums prior to the introduction of the code. So for these applicants, the major benefit was from a quicker, less intrusive and more streamlined service. The recommendations were limited, and that's probably again to be expected given the successful implementation of the code, given the fact that it's only in place for 1 year, and they really focused on mitigating internal risks from the insurer. So for example, in most firms, there was no requirement to opt in. So the applicant didn't have to tick a box that said, please, can I have the code? The code was applied by the insurer once the cancer diagnosis was disclosed. However, in saying that, some firms do have paper applications, and they had a supplementary paper that was to be filled out where the cancer diagnosis was disclosed. So it was really recommended that all applications with a disclosure should be manually reviewed with applicants to make sure that no information was missing. The report also suggested that all firms should have detailed documented practices for outlining how the code works. And this would have been regardless whether the code was applied manually or whether the code was automatically applied through the underwriting tool. And actually on that note, The review noted, excuse me, that there were increased risks that cases could be missed where the code was fully automated, in case that application or that disclosure was missed at outset when it was uploaded to the system. And the level of information required by firms differed. So some firms accepted the diagnosis with no further questions. Some firms accepted the diagnosis and had a few further questions on the type of cancer, etc. However, for all firms, the declaration was sufficient and no further evidence was sought in relation to the disclosure. Moving on now, one of the biggest benefits, I think, from this report was the case studies. The report detailed 6 case studies collated by Forbes Mazars of real-life examples of where cancer survivors found a difference in their case. And I think this really brought to life the benefit the code was actually bringing to cancer survivors in reality. So I've put in a couple of them here. So there was a stage 3A breast cancer case which was diagnosed in 2024, and that case was accepted at standard rates. Prior to the code, that would have resulted in at least an increased premium. There was also a case of testicular cancer, which was diagnosed and treated over 7 years ago, accepted at standard rates within 24 hours of application. Again, prior to the code, additional medical evidence would have been required for this case in order to be accepted. So again, you have that benefit of that streamlined, quicker process, getting the protection in place that bit faster. There was also an example of a malignant cancer which had been in remission for 7 years. That was accepted at standard rates for the cancer. However, it did receive a loading for other medical conditions. Now, prior to the implementation of the code, the risk would have exceeded the appetite of the insurers and would have been declined. So moving on from kind of these case studies, outside of the report, we do know from brokers, for example, that there are cases where applications were made in 2023, the application was declined and then made again in 2024 following the implementation of the code and accepted at standard rates. So again, like I said, all of these examples really provide clear evidence that the code is working for the benefit of cancer survivors. And it is achieving, I suppose, the objective, which was delivering real positive outcomes for these individuals much quicker. Now, the report did also note that it would be positive to take steps to kind of increase awareness of the code. As I mentioned, Gavin and Julie and I have done a number of these webinars, and we did in the run up to the code in 2023 kind of do a lot of these webinars and explaining with consumers and brokers. And it would be quite good to maybe do that again, continue to increase the awareness of the existence of the code and give comfort to cancer survivors that your application is going to be given the consideration it warrants. And there was a recommendation that the industry continue to take steps to promote the code. So what's next? Well, the government is introducing priority legislation, which is aligned with the Code of Practice as part of the autumn legislative schedule. And this is what Michael referred to at the outset in terms of one of the actions for the agenda for insurance reform. This means that the provisions of the code will move from a voluntary code to mandatory legislation, and that will ensure a level playing field across the market. Moving from domestic to a European perspective, discussions there continue regarding a pan-European code of conduct. Although given the development of the right to be forgotten frameworks in most European jurisdictions, I think that's proving rather difficult. And just a reminder as I finish up, any questions or observations, as Michael said, please do pop into the Q&A and we can take them up at the end. Back to you, Gavin.
Thank you, Jacqueline. So I think we just found where is next for the Society of Actuaries group as well. So it's quite similar to how Jacqueline has put it. So maybe just 3 points to kind of call out. So Paul, if you want to go on to the next slide there. So over the past few months, Julie and I, supported by Michael, have met with the Department of Finance a few times, who are responsible for putting the Code of Practice on a legislative footing and sort of help them walk through our numbers and help understand that. We've also been engaging with the Actuarial Association of Europe and the EIOPA to help them from a European perspective. So our expectation is that we'll continue to do that over the next few months and continue to engage. So hopefully we'll continue to monitor the impact of the Code of Practice and when it becomes legislation as well. But maybe there's a question which is not just for us, but maybe for all members of the Society of Actuaries now, is in what could we all do as an industry to promote this code, but also to make consumers and advisors aware that we do offer cover for people with pre-existing conditions. So, and that was what was shown in our original report. So I think there's onus on all of us to think about as we work on product design, as we work on marketing our products, as we work in our day-to-day roles, how do we make sure that we are getting across the good things our industry do, but also baking in accessibility to our products into every conversation we have around those topics, around pricing, product design, underwriting, claims as well. So I think a bit of maybe a call to action for the whole industry to do more in that space. So that's me. I think Michael, I'll hand back to you.
Thanks, guys. That was really insightful, really good. And just for me, listening to Jacqueline there, especially on the Forbes and Messars report, it's great to hear. I think the insurance industry just taking on that code and implementing it so successfully, and doing so like in the spirit of how it was intended, and even going beyond the requirements of the code in some cases. So I think it's great news. So a few questions. Maybe I'll start out with one, and probably this one for Gavin, and others can chip in. Is there any evidence, Gavin, that we talk about the premiums for consumers that have not been diagnosed with cancer? Any evidence that their premiums are increasing, given that the right to be forgotten now has been introduced? So I guess ultimately what's happening is some of these people that have been diagnosed with cancer are getting covers where in the past they wouldn't have had. So any evidence of that happening?
So as of yet, we haven't done that piece of work to do an evidence gathering, and to be honest, as a Society of Actuaries group, because of competition law, that we've tended to stay away from pricing topics and say actually it's not our place to kind of dictate to insurers what the pricing impact of these things should be. So we tried our best to just put data into the domain and then let insurers and reinsurers work together on their specific situations. So I think maybe Jacqueline will contribute about like what the code is trying to do in terms of achieving the balance between risk, cost, and accessibility. But we have seen some pricing impacts from other countries. So particularly from France, which was the first country to introduce Right to be Forgotten, but actually they went a lot further for a cohort. So they removed the requirement to underwrite at all below 200,000 in certain situations. So there was no underwriting, and we do hear of very material price increases there. So 20 to 25% being quoted, and potentially some insurers leaving that part of the market. So that's probably an extreme. I wouldn't expect Ireland to be anywhere close to that. But yeah, they're clearly, I don't know if Jacqueline, you want to talk about the balance and the risk?
No, but I mean, I think it was a really difficult discussion and a difficult decision about where the tipping point is, because that was what we didn't want to do. You don't want something coming in which has the unintended consequences of impacting access to a necessary product and the affordability of that product, not just for that cohort, but for absolutely every consumer that comes in. And the important thing about the code was defining those parameters, because ultimately it comes from an insurer being able to quantify their risk, right? If the insurer has the right information to underwrite, they can price more specifically. If they do not have the right information, they're guessing at a price, and insurers, we don't like to guess. We like to know, we like to forecast. So I think that was very important. And the more controls you put around a risk, the more you can quantify and understand that risk. So that was why we kind of thought, well, I think one CEO during this discussion had said, well, let's go up to 750,000, for example. And I think their technical person went, oh my God, no, that's too much. Let's start with what we can cover for the most part. So like as Julie mentioned, in looking at that 500k cap, for example, 90% of the mortgages that were in that population were below that amount. So you could cover the vast amount of affected cancer survivors with that amount. Now, I think as part of that, the French report you were talking about there, Gavin, on that, it found that there was an increase of 10% where the insurer knows the medical risk, but there was a decrease of 8% for the premiums where the risk was known. Sorry, so the 10% went up where the risk was not known by the insurer, because they had to have some kind of a buffer in place to account for not being able to quantify for that risk. But where the insurer did know the risk and was able to quantify it, there was actually a decrease in the premiums. So it just goes to show the importance of certainty and quantification for insurers in being able to price their contracts accordingly.
Super. Just staying with that theme for a second, right? And we spoke about the parameters of the code, but I noticed, I think, Gavin, you mentioned one of the countries don't apply, a limit on the sum insured. And get your point, Jacqueline, that look, 90% of the properties fell within the 500k upper threshold. But maybe just for the listeners on the call, why wouldn't we just say no limit and just have no limit on the sum assured?
I think Julie coming here as well is that, like, if we look at the intention in terms of allowing people to buy homes, is what we're trying to hear, and so the 500,000 is the mortgage amount, not the household amount, so the house purchase amount. So there is the 500,000, assuming there's a 10% or 15% deposit, then people are able to buy homes up to 550 or 575,000 if we're using this. I suppose the volatility of some anti-selection on some big cases. So if we talked about a 2-3 million case, like that, Ireland is a relatively small market overall as a global market, and a couple of big cases can have a very big impact on the cost overall, would be my personal view. So we again, I think it's probably that trying to achieve that fairness to allow people to buy a nice home, but not a mansion as such. So
yeah, no, I think that's it. And then just maybe, I think Julie, you made the point. I think that, look, we have the 8-year period at which the report our report was done and based on. We have seen probably significant house inflation, in the intervening period. So I guess we could expect that parameter to increase somewhat, with the introduction of legislation. Would that be a fair statement?
I could chip in with that one. Sorry, I didn't know whether you were kind of asking specifically. It's definitely, we know that it's under discussion with the department. We'll have seen Minister Donoghue had a parliamentary question recently which talked about it. And there was a discussion whether that was a parameter that could increase. And there is logic to that. The housing inflation is going up. The cost of housing is going up. The cost of average homes are kind of going up. So I think there is some merit in having that discussion. How much it goes up, if it goes to unlimited, that's a bit of an unlimited risk. But if it goes up to a quantified amount, I go back to the previous point, once there are controls in place which allow the insurers to quantify the risk of each case, then they are more comfortable being able to, obviously offer cover for that. It's where there is no knowledge and no quantification that we see insurers going, well, actually, I don't know if we can cover this, because we don't know how much the risk is going to cost us if that adverse event that the cover is meant to protect against actually happens.
On a similar note, guys, I see a question there from Noah Finnegan, and he's asking, exactly to that point, how likely is it that legislation will go beyond the current code? And I guess we spoke about the sum insured, but maybe on the 7-year period as well for the cancer survivors to be cancer free. Any thoughts on that one?
I think if I can refer you almost back to the same comments from the minister, that is something that is under discussion. However, I think it is really, I suppose, reassuring from an insurance perspective that the minister does recognise there can be unintended consequences here of too big a jump. So, for example, back when I mentioned the Shannon Private Members Bill, that was a huge risk because it was all insurance products and it jumped straight to 5 years. I mean, as Gavin mentioned earlier on when he was doing his comparison, 10 years was fairly common across the EU. Some countries had gone further, but that was after a period of time so that the system didn't just get shocked too much. So I do think that probably of all the parameters, it feels like they are the two that are under discussion from a government perspective, and we just wait and see what the legislation will actually propose.
Okay. And just on that,
sorry, probably worth adding, Michael, that so while the customer considers themselves cured and they've been through an awful experience and they're 7 years beyond that awful experience, from an actuarial statistical perspective, the survival curve for a group of cancer survivors and the survival curve for a group of people who haven't had cancer remain different for quite a while after that. So there is a different survival curve, and it takes quite a bit of time beyond cancer for them to get fully back to a non-cancer survival curve. So yeah.
Yeah, no, that makes a lot of sense. And maybe the answer here is to, let's see how it develops in the coming years before we do anything. It makes a lot of sense. Okay, we have another question here, guys. How important is it to keep the approach retirement to disregard versus right to be forgotten? So yeah, I suppose the question here is, Gavin, you touched on it. It's not so much a right to be it's not so much that the insurers are not getting told, but it's a right to disregard on the behalf of the insurance company. So they still see the data, and I don't think there's any reason or inclination to change that approach. Sure, there's not.
I don't believe so, but I suppose as actuaries, and most people on this call will be actuaries, we rather have the data than not have the data, and it allows us to make better assumptions around the changes. I think even the data that Jacqueline has shared with us today compared to the data that Julie compared to us, it's saying actually more people than we expected are benefiting from the code. So hopefully that shows that the code is working well. That people are. It'll be interesting to see whether over time that settles back down, because there might be a sort of a bump initially and then it might get closer back to where we expected. So people, as Jacqueline highlighted with that case from the broker who applied last year and then applied once the code came in. So there might be a little bit of that going on, but I think it's from a pure actuarial hat on, it's better to know your mix of risks that you're taking on and how you're pricing for those cross subsidies within your portfolio.
I think Jacqueline mentioned as well that, in the absence of data, you're kind of allowing for a buffer, you're having to build in the risk of having estimated incorrectly. So I agree. I think as actuaries, it is beneficial to have the data.
And I think the Forvis Mazars report, and the point of it was to show that the diagnosis was not being underwritten. It, to demonstrate, to provide, I suppose, faith in the insurers that they are acting in good faith and they are not kind of going, well, you had these kind of conversations at the start going, oh, the insurer is just going to say they're not, but they're going to underwrite it, they're going to charge us for it. Well, actually they're not, because now we've had an independent consultant go in and check it. And again, that should hopefully provide a bit more confidence and comfort to cancer survivors that they are being treated fairly. They always were, but we understood that there was a perception out there that maybe didn't tally with that. And hopefully this code will really help to kind of, I suppose, improve and rebuild that trust for cancer survivors.
One other question there was, some countries have expanded the scope of the right to be forgotten to include other diseases and illnesses, and and I think Hep C was one mentioned. I think is there any kind of inclination to go beyond the current scope from that point of view?
I think probably, yeah. Julie, go ahead.
I was going to say, I don't know about the inclination in terms of what the government's looking at currently, but I guess, we did call out in our original report that from a consumer fairness point of view, expanding it could address further perceptions of inequity, that consumers who've recovered from other illnesses might feel unfairly treated. And a broader framework, again, could improve access to financial services, which is something I think as an industry we all want to achieve. However, you do have to kind of approach it with caution. I suppose that we've talked a little bit about cross-subsidization already, potential to increase premiums for consumers without prior conditions, which could in turn affect overall market participation and product viability. That again, you'll be bringing in the risk of increased adverse selection. And really, I suppose at the heart of what we do is the principle of risk pooling. So the more we remove that, the more there is the potential for higher costs and reduced availability of cover. So I think really it goes back to the conditions, and as Gavin mentioned, the kind of survival curve and whether that does or doesn't get back to kind of general population or not. Sorry, Jacqueline.
No, I think you've put it exactly correctly, Julie. I mean, all I was going to say is, Gavin kind of mentioned that survival tail as well. With cancer, the longer you survive without a recurrence of the cancer, the less the risk of it recurring actually is. And of course, insurers are all about insuring risk, right? But with other conditions, heart attacks, etc., there's no medical evidence showing that the longer you survive, the lower your risk is. The risk maintains steady for a number of other conditions. And that's why a right to be forgotten framework works for a cancer condition, but may not actually work for other conditions from a pure risk perspective. And perhaps the other countries who have expanded it out was for more of those points that Julie mentioned in terms of, you know, increasing awareness and including and covering more actual patients in there.
I think it's a good challenge to the whole insurance industry as well, to make sure that you're using up-to-date underwriting outcomes so that you're continually reviewing your underwriting outcomes. If you're relying on a reinsurer manual, that you're working with a reinsurer who's continuing to update their data going beneath that, so that like my understanding is the reinsurance manuals aren't static things, are continually being worked on and continually being improved as new data becomes available on the relative risks. So, but I think there is an onus on insurers to make sure that they're also reviewing their underwriting outcomes to say, actually, that remains fair and that remains evidence-based, and that we continue to improve. And I think if we had looked at a report from April 2023 that looked at that outcomes, I imagine that if we'd looked at that data 10 years earlier, we would have seen a very different set of outcomes, because cancer survival rates have improved so much in the last 10 years as new treatment options become available. So I think there's an onus on all of us to kind of make sure we're continually reviewing our underwriting outcomes and continuing to make it more accessible as new data becomes available.
And then, so just finally, guys, what can we expect in terms of legislation next? Jacqueline, when can we expect that come into play?
So I think the hope from the department was that we would see something before Christmas, but obviously a lot of other priorities and political objectives can take precedence, and we've seen a lot of that recently. So we're probably looking at sometime after Christmas, perhaps seeing a general heads of scheme or perhaps a full bill before it proceeds to legislative scrutiny. That being said, things can change in a day when it comes to politics. But I think it's certainly our expectation that we will probably be more likely to see it after Christmas than before. Okay.
It was good to go in and meet Minister today, Troy, and some of the Department of Finance guys, and it was, I think, you know, it's good to see that they really have their finger on the pulse, you know, and understand the issues here as well. So looking forward to seeing what they come out with. I think that's it, guys. I don't see any more questions. And we're gone a little bit over, but I think it was worthwhile. And just want to say thank you to the three of you for coming along today and for, you know, explaining those, you know, they're quite complex issues when you get into the nuts and bolts of it. I think it's been very educational for me and for hopefully for the audience. And just want to thank you for all the work you've done on that space, you know, because it's a real success story, and well done.
Perfect. Thank you very much, guys. Thanks, everyone.
Thanks a lot.
Bye.
Bye-bye.
Take care now. Bye.